Here to break down the latest economic data and what it means for the U.S. economy, we've got Lydia Boussour, EY's senior economist. And to help put this into context from a global perspective, we've got Jeffrey Kleintop. He is Charles Schwab's chief global investment strategist. Lydia, I want to start with you here because existing home sales coming in at 3.84 million, falling 1% to a 14-year low here. That feels very significant to me. What is your reaction?
Yeah, I mean, I think the data really shows that we continue to see some downward pressure from higher interest rates on the housing market. Housing activity remains under pressure. When we look at the overall picture, we still have a depressed housing affordability in the US. It's still hovering around its lowest level since the 1980s. So we continue to see, essentially a housing market that's frozen and where elevated interest rates and that restrictive policy stance is putting downward pressure on activity.
Lydia, how big of a risk do you see this being to future economic growth?
Yeah, I mean, we have the Federal Reserve that has started to lower interest rates. So as we move into 2025, we do expect to see some of that pressure easing on the housing market. So we do expect to see a gradual recovery. But overall, when we look at the economic picture, we continue to see an economy that's moving at a fairly solid pace. If you look at economic growth in the third quarter, we're looking at growth above 3% for the US economy. We're also looking at a consumer that's still spending, even if it is doing so more cautiously, especially for lower income households. I think it's important to stress that we have this bifurcated consumer when it comes to the US. And overall inflation continues to move in the right direction. So I think the economy overall remains on solid footing.
Yeah, it's also interesting noting that median home prices rose 3% from last year. Certainly bad news when you think about the Fed's path forward and the relationship of interest rates to home prices. But Jeffrey, I want to bring you into the conversation here, just in terms of how the macro environment has been impacting particularly fixed income over the course of the last week. We're still seeing that rise in yields, the 10-year at over 4.2%. How long do you think equities can withstand that kind of upward momentum?
Well, we'll have to see what we hear this week and next week from an earnings perspective to see how that can be sustained. Valuations are very high. And of course, we know when longer term rates rise, that puts downward pressure on valuations. And U.S. equities are pressing on a fairly robust outlook for earnings growth next year. Analysts are looking for double-digit growth. And the problem with that is that we're actually seeing economic growth slow. I'm not looking for a recession in the U.S. next year, but we are seeing GDP growth slow. According to the IMF estimates, came out, yesterday, from 2.8% this year to 2.2% GDP growth next year. And the PMI, which is a really interesting indicator of what's going on with earnings. Usually it leads earnings by about 3 months in its trend. The US PMI in manufacturing is showing signs of weakening. Even as analysts have been revising estimates higher, we've been seeing economic outlook from those same business leaders revised downward. So I think it'll be interesting as we go through this earnings season with very few upward revisions to estimates as over the last few weeks. If we see a beginning of a downtrend in earnings growth tied to this somewhat softer outlook, that could undermine the stock market's gains this year. We've already seen some weakness this week that could extend into next week as well.
So what does that tell us about the potential levels that we could see for yields then, if that were in fact to be the case?
Well, they could come down a little bit. We think that this probably the time to extend duration is probably past at this point. Maybe yields stabilize a little bit here. I think where we might see rates come down more dramatically is outside the U.S. We just had 15 minutes ago a 50 basis point rate cut from the Bank of Canada as the economy slows there and inflation's coming down rapidly. In fact, inflation's coming down much more rapidly outside the U.S. than inside the U.S. I think you could see more downside to yields, both in the short and longer term outside the U.S., which could really benefit valuations where they're still relatively low, and that could benefit international performance here in the fourth quarter.
Lydia, I'm curious how all of this ties into both your thoughts on the next Fed meeting and just the amount of growth that we do continue to see in the U.S. despite some of that kind of bifurcated consumer that you mentioned. Given that we do keep seeing strong data in the face of that, do you think that we could potentially get a no-cut November?
Yeah, that's not our base case. If you look at the overall economic backdrop, we're also in the camp that economic activity overall is softening. and that as we look into 2025, we should continue to see that gradual and gentle slowdown in activity. For consumer, we are seeing more prudence on the part of consumer, but businesses are also being more cautious with their spending. So from a risk management perspective, when you think about the Fed going into the November meeting and the end of the year, we still have a labor market that has softened and that is back into balance. So you're no longer seeing that upward pressure on inflation. And at the same time, we have inflation that continues to move in the right direction. So I do think that there is still a solid case for the Fed to move away from that restrictive policy stance. And so we're expecting to see a 25 basis point rate cut at both the November and December meeting. And as we head into 2025, we do expect to see that continued cool down in activity carrying over into next year. And we do see growth, at around 1.9% next year. And that would come down from about 2.7% expected this year for US growth.
Jeffrey, how does that compare to your expectations?
Well, I think as we take a look at interest rates, central banks seem to be on a path for easing pretty much at every meeting of European Central Bank, Bank of Canada, the U.S. Fed. I think that's old news now. I think it's time for investors to pivot to a focus on fiscal policy. Of course, that involves taxes and spending. And of course, we've got a U.S. election coming up, so that could be up in the air. But I think what's interesting is that we are starting to see a shift towards tighter fiscal policy. At the same time, central banks are committed to easing monetary policy. And when those two move in opposite directions, the outcome is not all that certain. Generally, it can mean a drag on earnings growth, even if it lifts valuations. We're seeing big economies like Germany, France, Italy, China, all pursuing tighter fiscal policies, intentionally or unintentionally, this year and next year to rein in their budgets to meet targets. And that could result in a drag on GDP, a drag on earnings growth. At the same time, monetary policy is trying to boost it. So there'll be a bit of a tug of war between monetary and fiscal policy next year, something we didn't see in 2023, 2022, or 2021, where they were in sync.
Jeffrey Kleintop, Lydia Boussour, thank you so much to both of you for kicking off the
Thanks.
hour with us here.